You ever see the stock market just soar on what seems like terrible economic news and think to yourself, what on earth is going on here? Well, you're not alone. That's the strange, kinda upside-down world we're living in right now. It seems like bad news is actually good news? In this explainer, we're going to decode exactly why that is. So, let's dive right in.
All right, so here's what we've got on tap. First, we're going to unpack this whole bad news is good news puzzle. Then we'll look at the really tough spot the Federal Reserve is in. After that, we'll explore the two big paths the economy could take from here: the super optimistic soft landing and the much scarier stagflation trap. And to wrap it all up, we'll give you the key signals you need to be watching and, most importantly, break down what this all means for your investments.
So let's just get right to it. The big question is, why would markets celebrate bad economic news? I mean, it feels completely backward, doesn't it? Logically, it makes no sense. But the answer, and this is key, has nothing to do with the news itself. It's all about how investors think the most powerful player in the game is going to react. And that player, of course, is the Federal Reserve.
And that leads us straight to the Fed's massive dilemma. Look, they've basically got two main jobs: keep prices stable, fight inflation, and keep people employed. The problem? Right now, the data for those two goals is pulling them in completely opposite directions. It's a huge economic tug-of-war, and the Fed is stuck right in the middle.
So on one side of the rope, you've got inflation that just refuses to go away. The latest CPI report shows that core inflation, and that's the number they really watch because it strips out the wild swings in food and energy, is still stubbornly high. We're talking about sticky costs and things like services and rent. But then on the other side of the rope, the job market is starting to flash some really serious warning signs. There was a sudden, shocking spike in the number of people filing for unemployment. And get this, it was really just one number that sent the markets rocketing higher: 263,000. That's the number of weekly jobless claims. It's the highest level we've seen since October 2021. I mean, way more than anyone expected. This one data point, this single number, totally overshadowed all the bad inflation news. Why? Because it signals real economic pain, the kind of pain the market thinks will force the Fed to step in and do something.
And just to be crystal clear, that inflation data was not good. Yeah, the headline number you see on the news got a big push from volatile stuff like gas prices. But the core number, the one the Fed really cares about, is still stuck above 3%. And that's the important part. The sticky bits of inflation, the stuff that's really hard to bring down, are still a huge problem.
Okay, and if you look at this chart, it tells a really important story about the underlying trend. Just look at the last 3 months. The momentum, the speed of core inflation, it's not slowing down. It's actually speeding back up. It's going in the completely wrong direction from the Fed's perspective. And this right here is the inconvenient truth that the market just decided to ignore last week.
So what's the market's big bet? It's that when the Fed is faced with these two problems, sticky inflation on one hand and a weakening job market on the other, they'll choose to save the job market. They'll be forced to pivot. This is what everyone is calling a dovish pivot. Basically, it's a shift from being tough on inflation to being soft or dovish and cutting interest rates to help the economy. The market saw that bad jobs number and screamed, "The pivot is coming!" That's why it rallied. And just like that, bad news became great news for investors.
All right, so this whole idea of a pivot puts the economy at a major fork in the road. There are two very different paths we could go down. Let's start with the optimistic one, the one that investors are clearly betting on right now. We'll call it Path 1, the soft landing.
The logic for this bull case is actually pretty simple. It goes something like this. Step 1, the weak job data forces the Fed to act. They just can't ignore it. Step 2, they start cutting interest rates. That makes money cheaper to borrow for, well, pretty much everyone, from regular people buying a house to huge companies wanting to expand. Step 3, this new stimulus keeps the economy from falling into a nasty recession. Instead, we just kind of glide down for a perfect soft landing. And the end result? A fresh flood of liquidity, of cheap money that fuels a huge rally in assets like stocks and crypto.
But there is another path, a much more dangerous one. This is the bear case scenario. It's the one where the Fed's big dovish pivot isn't some brilliant move, but a huge policy mistake, one that could lead us right into something called a stagflation trap.
You see, the real danger here is that the Fed could be focusing on the wrong problem. The whole bear case argument is that inflation is way stickier and more persistent than anyone at the Fed thinks. So if they start cutting rates now, they risk pouring gasoline on an inflationary fire that's not even out yet. And that could lead to the absolute worst of all economic outcomes: stagflation. That's when you have slowing growth and high inflation at the same time.
For a market that's already flying high, a stagflation shock could be an absolute disaster. So let's just put these two futures side by side because the contrast is pretty stark. In Path 1, the soft landing, those lower rates are like rocket fuel for the economy, boosting growth and making investors very happy. But in Path 2, the stagflation trap, that persistent inflation just eats away at everyone's real income, it crushes consumer confidence, and it squeezes corporate profits. I mean, we're talking about two completely different worlds, all stemming from this one single policy decision.
Okay, so the billion-dollar question is, how do we know which path we're actually on? Well, this is where you get to put on your analyst hat. There are some very specific signals, some key data points you can watch over the next few weeks and months that are going to tell us the story.
In the short term, like the next month or so, you've got to pay close attention to the tone of the next Fed meeting. What are they saying? And even more important, watch that next non-farm payrolls report. That's the big one, the main monthly jobs number. If it's weak again, the market rally continues. If it's surprisingly strong, that could cause some serious chaos. Then, looking out a bit further, over the next few months, keep an eye on what companies are saying about their future earnings and whether people are still out there spending money. Those are going to be our biggest clues.
All right, let's get to the bottom line. What does all of this actually mean for your money? How does this economic fork in the road translate into actual investment plays? Let's break it down. You know, there's a quote from the analysis we're looking at that just perfectly sums up the market's thinking right now. It says, "The market has demonstrated a clear preference for trading on the Fed's reaction function rather than the nuances of the inflation data." What that really means is, forget the nitty-gritty inflation details. Right now, it is all about one thing, betting on what the Fed is going to do. And that one simple idea is driving the entire investment playbook. So, if you're trading on that one single thesis, here's what the playbook looks like. First, you're bullish on stocks, especially the ones that love lower interest rates, like tech stocks and smaller companies. You're also bullish on bonds because you expect yields to drop when the Fed starts cutting rates. Gold also starts to look really attractive since it usually does well when real yields fall and the dollar gets weaker. Oh, and of course, the high-risk, high-reward stuff like crypto and real estate. They're expected to thrive on all that extra cash flowing into the system. The only major thing this playbook is bearish on? The US dollar.
So here we are, right back where we started. The market is placing a massive bet. A bet that bad news for the economy will continue to be good news for their portfolios, because it'll force the Fed to act. But that big, ugly risk of sticky inflation is still lurking in the background. It feels like the Fed has chosen its path, at least for now. The only question left is, where does that path lead? To the glorious soft landing everyone is hoping for, or right into the jaws of the dreaded stagflation trap? The signals we talked about are going to give us the answer, so keep watching.